Welcome back. You are watching a Stock Watcher with me, Zinati Guma, and joining me to take your stock-related questions tonight are Mark Du Toit from Oyster Investments and Alex Duys from Umthombo Wealth. Please be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS to 41392 or on X using the hashtag StockWatch. Thanks so much for your time, gents. Mark, is China driving the markets today and actually this week?
Yes, indeed. So, we've had a fantastic rally the past 2 days, all driven by somewhat surprising stimulus package announced by the Chinese Politburo on Tuesday, basically announcing that they're going to increase monetary easing, cutting the RRR rate by 50 basis points, injecting some stimulus into the property market through lower mortgage rates, and then also announcing liquidity measures to help perhaps inject some life into their stock market as well. So all these measures, I think the market's been looking for a place to put its money to work after the US started cutting rates, and China gave them a good reason to buy Chinese stocks.
Yeah, and investors' money is definitely working on a Prosus. And there's a question here, Alex. View on Prosus after recent rally and a Chinese government recent stimulus package. Is there still room to run, or is it a sell at current levels? I think it was up about 7% today, Alex.
Yeah, so we are still very constructive on Naspers, Prosus and Tencent over the medium to long term. So despite the recent strong rally, and the stock has bounced from probably 3,300, 400 odd of recently, so it's done quite well. But despite that, we still think it's very attractive. And there's numerous reasons for it. So Tencent is very well positioned. We think that they will continue to sell the associate stakes, which will add a lot of value in our view. And the underlying core business continues to do well. They're buying back shares at Tencent level. They're buying back shares, of course, at Prosus and Naspers level. So we think that is very accretive. And if you look at tech stock valuations from China compared to US, it's an enormous differential. And a lot of investors have moved away from China, saying it's uninvestable. And that, of course, means that the sentiment is probably swing too negative. And as well, I think it's quite attractive. So we like it. So yes, certainly we will continue to buy and hold at these levels.
Something else that the markets like, I know that, Mark, you are choosing Prosus as your stock pick, so you will get your turn to talk about it at the end of the show. But some of the other stocks, we did see luxury, Richemont, LVMH, Kering. Is this a time to get excited? But also in your excitement, would you say, just the broader luxury market, will benefit from this? Or maybe is it time to get a little bit more picky about what you choose within that luxury basket?
Yeah,
sorry, Mark.
We discussed Richemont last time on the show. At that stage it was looking, like a reasonable entry point. It has rallied quite a bit since then. I think that the stimulus measures that the Chinese government are looking to introduce is more supportive at the lower end of the market and less in the luxury space. So there's not a kind of a direct line that you can draw between these stimulus measures and the luxury market. But it's still, it will help support demand for luxury goods. I do think that it feels like this recent pop in luxury counters is perhaps just a bit of a sort of a hopeful bounce, and we will need to see some underlying demand return to that market. For a long time, they traded on very high multiples, and that kind of steam has came out recently. But we're not very excited about them at these levels.
And Alex, it's actually quite interesting because for the last while we've seen very heavy moves either to the upside or to the downside with these luxury stocks. Is that something that investors need to keep in mind, that they may be just very, very vulnerable to these big moves on either direction with any little bit of news that the markets get?
Yes, correct. So luxury companies tend to be quite cyclical, and that moves in line with capital cycles as well as market cycles. So because most people that buy luxury goods is based on their wealth or how wealthy they feel they are, right? So as your asset class prices change, for example, property prices in China, which is a bit under pressure, means people are willing to spend less on luxury goods. So that is a factor. So usually we'd like to try to buy these type of companies when sentiment is negative and when they're on a downside cycle, and then hold them for longer terms of period. They have done quite well, of course, over the last few years, and we are seeing a bit of a pullback. But other than that, I think it's more to note that some of the companies will be more stable than others. But certainly that is the overall theme in luxury, because there's a little bit of cyclicality in there that investors need to be aware of.
All right. Well, talking about themes, there's obviously a big cybersecurity theme going around, and one of the counters that has come into favor because of the need for increased cybersecurity is CrowdStrike. So there's a question here: is CrowdStrike a buy, or should one wait until things are settled down, depending on whether any lawsuit might come to them? Of course, when was it? About 2 months ago, we all saw the impact of the blackout that affected Microsoft services. At this point, Mark, because we saw a lot of selling, but also a lot of people saying that this was an opportunity to go into the stock. Would you classify it as a buy on your side or not?
Yeah, so I think in general we've been a little bit hesitant of US tech stocks this year. They have had a very strong rally over the last 10 years. It's looking like a bit of a crowded trade to us, so we haven't been really fishing in that pond. And I don't know CrowdStrike well enough to offer an opinion. But yeah, litigation in the US, and we're seeing it more and more, US, Canada, the UK. These are becoming big issues, and the amounts are really large. So that would worry me.
Crowded trade, CrowdStrike. Yeah, I got that, Mark. Alex, on your side, what would your view on a CrowdStrike be? Of course, looking at all the noise of the lawsuits as well.
So unfortunately, I can't add to what Mark has said, because I don't look at the stock in a professional capacity. But one thing I'll add there is there's a reason lawyers are so rich in the US, because they love litigation. So you can expect a lot of that going forward.
All right. Maybe I should have been a lawyer. Let's go into British American Tobacco. After the recent correction, what's your view after the recent correction? Still looks cheap at these levels, with interest rates coming down and a high dividend yield on the stock. Mark, BAT?
Yeah, so we have seen British American Tobacco have decent performance, share price performance this year. For a while now, it's been looking very cheap, and now it's looking a little bit more at a more normal kind of valuation level. It's another company that has a lot of litigation. It's being sued by the Canadian government in Canada, and might have to walk away from its business there. But that's already in the share price, I would say. Okay. So I wouldn't say that's a determining factor. I think that if you're comfortable with the business, that it's got a good dividend deal, it's going to continue to pay down debt. I think its business has the potential to grow in the next generation kind of vaping, heat not burn products. So I think I definitely wouldn't sell it at these levels.
Okay, wouldn't sell it. All right. Alex, is there any kind of appetite for BAT at these levels on your side?
Yes, we are still constructive on account short to medium term, as long as the increase in pricing can offset the volumes, and they get some benefit from emerging market currencies at some stage in the future, and they can reduce interest rates. That means they could probably, reduce interest costs. They could probably grow in earnings, and if they can grow earnings, then valuation is still cheap. The balance sheet is in a better position now, so they can do share buybacks, which will be another value add. And the more they get the debt levels down to what the levels they want to be, you can expect more share buybacks. So I think that's really going to grow the narrative over the short to medium term. So from a political risk perspective, if the Democrats do come in charge, that could be more negative, or remain in charge could be more negative for tobacco relative to Republicans. So that's something to think about in the US, specifically when it comes to menthol. A little bit on that before the election, I could actually restart that again post-election. And menthol is a very important part of BAT's US business. So that's something to think about post-election from a risk perspective.
That's actually quite an interesting layer there. Well, let's come back home and take a look at Capitec. Should one buy Capitec to keep over the long term, even at current record levels? Mark?
Yeah, Capitec's had a phenomenal run. Share price up over 40% this year already. They've had a recent trading update which said their earnings are going to be up over 35%. So yeah, so I mean the share price has really done quite a lot, but it is a great business. They have grown their account base to 22 million accounts, and they're now busy rolling out products into their app and selling products to all their customers, and which is driving the growth in their NIR, the non-interest revenue line. So yeah, I think that there's still a long runway ahead of Capitec. The price of the share is expensive. It's not a stock that we are overweight at the moment, but I mean, we do like the business. We would just like to buy it at a better price. I think if you are going to hold the stock for 10 years, you're probably going to be fine. You'll earn a fair return. But for us, I mean, we prefer the beaten up ABSA, which I think the macro is going to benefit ABSA more in the shorter term. And we're looking for a bit of a catch-up trade in ABSA before we would buy Capitec.
Yeah, it's quite interesting that Mark also mentions a time horizon there, Alex. Is this a stock that if you really just believe in the growth story of it, you can buy it even if it looks full and just close your eyes and you'll still be fine?
I must agree to that, though I do think there will be a better opportunity to buy the stock. If you look at the forward valuations of the business, every now and again there is a period where you can pick it up at a better, more attractive valuation. I think at the moment it's a little bit too high for our liking. So I concur with what Mark said. The business operation is very well positioned. Going to hold for long term, probably will do well, but perhaps a little bit greedy. I'm looking for a better entry price.
Okay.
So yeah, I think that's the key for me. So if there's any form of, call it 10%, 20% pullback, or perhaps just no movements in 12, 18 months, then it could be perhaps a better entry point there.
Better entry point, Alex. Mark mentions that maybe he'd rather be looking for opportunity and beaten down ABSA. Is there any bank that you're like, you know what, maybe that would provide a better opportunity in the short term before Capitec gets to that attractive entry price?
Yeah, so look, ABSA is the one that's been really lagging, and for good reason. The business has struggled, but valuation is very compelling, and we would argue from a asset manager perspective, there's very high margin of safety, meaning a lot of things can still go wrong and you probably will still earn a decent return.
Okay.
But if they do things right, you'll make a normally good return. So I think that's why from a risk return perspective, we do have a preference for ABSA over Capitec, but it'll be more of a short to medium term trade.
Okay.
I don't necessarily like ABSA on a long term perspective.
All right. Actually, Alex, there had been lots of questions on Mustek in the last couple of weeks, and I don't think a lot of people really look at it in depth. And I just thought of you because it seemed like they did have a bad period when they released their last results. I know that you were very constructive about it. What would be your view at this point? Has anything changed, or are you still as constructive as you were a couple of months ago?
Okay, so let me first start on the operational side of the investment case. So Mustek did deliver poor results, but I think it was well guided for and quite understood by the market because they were pretty much overstocked in renewable. You think about solar panels, batteries, and so forth. So they currently have about 600 million in inventory, and they're targeting only 60 million. So that means they have to sell about 500 million of inventory over the next year to 18 months. So that is the reason why they struggle now, because demand has fallen off the cliffs, revenue is not there, and GP margins are lower. So it's actually for the viewers out there, if you want to buy solar panels, the time is now. So that really meant that the business is overstocked, and that there's also cost involved to that because you have to have accounts payable and the like. So overdrafts. And that's led to this disastrous set of results. But this is the new low, and they're going to reap new base, and they're going to grow from here onwards. How are they going to do it? By getting rid of the inventory, reduce debt, and then reinvest in other parts of the business where there are growth. Because they did mention the PC side of the business is doing quite well. So if the economy continues to pick up, companies will have to replace their computers again, and Microsoft license also, Windows 11 is also going to be necessities. A lot of companies will have to upgrade and so forth. So that's the operational side. So I think the business is relatively well positioned. And then second is from a corporate action perspective, there's certainly something happening at the moment when you look at the share register. One of the big shareholders, Old Mutual, has pretty much sold out, and there's now a new big shareholder building up a position which has not yet been known to the market. So either there could be some form of activist shareholder or just a new investor or like to take over. We don't know, but that's the reason why the stock's also gone from about 9 rand to about 14.50. So there's been a big buyer in the market, and I think that also is one of the reasons why there's a lot of interest in the business. So I would say I'm constructive on both of those two aspects.
Well, I mean, Mark, I'm not sure how closely you follow Mustek, but I mean, for last year, there was a very big renewable energy trade. I mean, even counters like Roinet, as we experienced a record load shedding, but obviously no load shedding now. I don't know, would these still be on your radar? Were they ever on your radar? And if they were, would they still be on your radar, even with the relief that we've had from load shedding?
Yeah, I mean, I think that there probably is just a bit of an overstock situation in South Africa. I mean, it's very easy to delay your purchasing decision on solar when the lights are still on. But seeing the price increases that Eskom's asking for, I know it's just their opening ask of 33% increase, but electricity prices are going to go up ahead of inflation, and it makes the solar panels just so much more worthwhile putting in. And we're going to see large infrastructure rollouts in the renewable space. So I still think it is a constructive space to be in, perhaps just a bit of an overstock on the solar panels in the shorter term.
All right. Well, let's go into coal. So yeah, just a broad question on coal, and then I'll go into the specific counters shortly. Actually, there's a nice message here. I watch your shows every day for over 10 years. A very, very loyal viewer there. Please ask the panel if it is time to sell and forget coal stocks. Yeah, forget, I don't know. Doesn't it seem like a little bit of an exaggeration here, Alex?
Yes, I would not agree with that. Coal be a minority, but I'm actually quite positive on coal prospects. If you're looking for demand for coal, it's actually quite still steady, and probably it's going to grow in the short term still. And what politicians want to achieve with the move to renewable energy is simply not achievable. So the world still requires baseload energy, of which coal will remain a big component of that. And the fact that banks and investors aren't willing to fund new coal mines means you are going to start getting a bit of a demand-supply cliff, or supply cliff, meaning there will be lack of supply in the future, and that will probably price. Now, I'm not saying this is necessarily 100% fact that this is going to happen, but that is my feeling. I do think the lack of investment in coal is going to cause opportunity. It's going to probably lead to higher prices for longer than I think most people think. So I wouldn't ignore coal at all, but that doesn't mean I'm going to go gung-ho either.
Yeah, okay, all right. Mark, on your side, and I guess the second part of that question is, if you would still be holding a coal, would there be a preference between Thungela and Exxaro?
Yeah, so I mean, I think that the coal stocks are difficult shares to own because there's so much operational leverage towards the rand coal price. So, you know, as coal prices go up and down, the earnings of the companies fluctuate a lot. And you know, it's difficult for people to hold on to shares that are, you know, have such highs and lows and are very cyclical. You know, maybe in the longer term, I agree. Like, I think long term, there's probably not enough investment into the coal. And so coal prices probably structurally are higher than what they would have been before. But it doesn't necessarily mean that you're going to be a happy shareholder when your shares are going up and down 20 to 30% a year because of the vagaries of the energy markets. So I guess out of the preference there, if you buy Exxaro, you're at least getting exposure to iron ore as well. So their big investment is they've also got a lot of investment in the iron ore space, so you're getting that diversity. Exxaro's got a lot of cash in the balance sheet. I think it's over 10 billion rand. They are looking to expand into new commodity markets, so they're going to spend that money buying possibly something in South Africa, looking at a new commodity to add to their business. So yeah, so if I had the choice, I would pick Exxaro over Thungela just because it has more diversity and less volatile earnings, although it's still a commodity stock.
Yeah, all right. Well, sticking with commodity stocks, let's go into gold with Anglo Gold Ashanti. Why did Anglo Gold's share price sharply decline after they bought a stake in Egypt's Centamin? What is their way forward? Was it actually that, or was it just maybe just broader market sentiment then, Alex? Because we do know that the gold price is quite volatile.
Yes, I'd rather talk more in general regarding business. So I think the problem is the gold companies are having obviously a fantastic time, generating record free cash flows, but investors are not getting it through dividends. And you see it through pretty much all the counters. And now Anglo Gold as well, they got money that's burning a hole in their pocket, and they decide to do a deal in Egypt at the top of the cycle. And usually that's a negative signal to investors. Now, that doesn't mean that the asset they are buying is bad and so forth. As far as I'm able to gather, it's actually a good asset in the overall scheme of things. But, investors would like to have some money in their pocket. So I think that is a concern. DRD is the same. They're doing CapEx projects. Harmony is doing the same, spending money. You're not really getting that money in the pocket. As a result, some investors, patience, I guess, but running out.
All right. I hear that point. Mark, would you have anything to add there?
Yeah, I think that the share price reaction was one, shareholders were not expecting Anglo Gold to make an acquisition. We're expecting them to use the cash flow to develop their gold assets in Nevada and America. So it was a bit of a surprise. And then number two, they bought an asset in Egypt. And none of the existing Anglo Gold shareholders would know much about Egypt as a country. I spent the day learning about how the mining legislation works, why the effective tax rate on their gold mine is effectively 50%. It's not a jurisdiction that the market knew well, so it was a bit of a shock. And then it's a market that shareholders didn't know, so people probably also acquisitions are normally not accretive. You tend to overpay. In this case, it does seem like they didn't overpay, and they used their paper, their shares, to buy the stock. So it was a good deal in that respect, but just in a market that no one really knows well.
All right, gents. Before we get to your stock picks, an old age comparison, SAPI versus Mondi. Please discuss the merits of SAPI versus Mondi, either a possible buy. Alex?
Sure. I think Mondi is a much better quality business, and obviously focuses more also on the packaging component, which makes it a bit more durable and there's a bit of a growth fee. Now, in the case of SAPI, it is quite a cyclical stock that you can buy at opportunistic periods.
Yeah, okay.
Specifically when they can deleverage and their margins are low, meaning that they start getting a bit of a purple patch and they deleverage at the same time. You could see equity value double easily at type of business. That's more of a shorter-term trade as to a buy and hold stock. So be careful when you buy SAPI, and you probably need to do your homework on those markets. It's not as simple. I think Mondi is easier to understand from my perspective.
Yeah, and really also what I'm getting from you is that SAPI may be then more cyclical than Mondi. Mark, any additions there?
Yeah, I think that if you want to buy a stock for a longer term, I think Mondi is probably a better option. It's also interesting they're both in paper, but Mondi's more exposed to the packaging cycles, and then SAPI's more exposed to textiles because one of their main business lines is dissolving wood pulp, which goes into fabric ultimately. So two paper companies, but vastly different in markets. Yeah, and I think Mondi, if you're gonna buy and hold for a long term, is probably an easier one than SAPI.
Very interesting. All right, gents, let's quickly get to your stock picks for today. Alex, what are you picking?
So I'm going for 91. The stock has been going nowhere for quite some time, and I think the market is missing a little of the boat here. So why is 91 struggling? First of all, US market has done very well, specifically tech stocks. It's been driven mostly by ETFs, so lack of flows out of active managers into passive. Also, developed markets have done a lot better than emerging markets. I think that at some stage is going to reverse to some extent. I think when that asset flows start coming back into emerging markets or away from tech stocks, I think a business like 91, which is a global asset manager, it's got assets in Asia, Europe, North America, as well as Africa, will start getting flows and do well. And if 91 can grow earnings at any level from this base, stock in our view is extremely attractive. So we think it's one for that investors that got some patience, because we don't know when the market will turn. But if it does turn, we think there could be a normal profits in 91.
All right. And your stock pick, Mark, is Prosus.
Yes, so buying Prosus, principally to get exposure to Tencent. I mean, their business is doing very well. The gaming side of the business is thriving, and they've got the opportunity to move more into overseas markets. So that's a nice additional opportunity for them. And then their advertising, online advertising, the business services segments are very geared to the Chinese economy. And now that we're seeing more stimulus, particularly aimed at consumers in China, I think that there's another tailwind for the Tencent business. So you're going to get your revenue growing at 8 to 10%, your earnings grow above 15%. Added to that, they've got the ability to buy back shares, which is another way for you as a shareholder to get return. And I think it all adds up to a 20% a year return, even after today's and yesterday's move in the share price.
All right. Thank you so much for your time and for your analysis today, gents. That is all for tonight's Stock Watch. Thanks to our guests, Mark Du Toit from Oyster Investments and Alex Duys from Umthombo Wealth. Up next, the close. Stay tuned.